Bank of Canada is scheduled to announce its next interest rate and release its updated forecast for the economy in its monetary policy report on Wednesday. The central bank is widely expected by economists to keep its key interest rate target on hold at 4.5%, but its view of how the economy is unfolding will be scrutinized. The bank held its overnight rate steady at 4.5% in March after 8 consecutive interest rate hikes. All of this comes amid the rising cost of living and food inflation that continues to put pressure on Canadians' wallets. So what can be expected from the Bank of Canada's highly anticipated announcement on Wednesday? Well, joining us now to give us his take on this in our weekly Caldwell Securities segment is Brendan Caldwell, Director at Caldwell Securities Limited. Brendan, welcome back to Forum Daily.
Nima, always good to be here.
Always good to have you, Brendan. So we mentioned the Bank of Canada is likely to hold interest rates steady at 4.5%. But what are your thoughts on this? What are you expecting from Wednesday's announcement?
Expecting a whole lot of nothing, Nima. So yes, you're right. Banks don't like to surprise. Any surprise from banks, as we've seen over the decades, or I've seen over the decades at least, nothing good comes from that. So while it's supposed to be a in-camera secret thing, and then the announcements rolled out, they telegraph fairly loudly what their intentions are, so the market doesn't get blindsided, because every time they've done otherwise, it's been a thing. Here's the trick, though. If they don't raise rates, and the Americans continue to raise rates, which is, I think, more likely, then you'll see an increase in the difference between U.S. and Canadian rates. That tends to cause the U.S. dollar to go up relative to the loonie, which in itself could be inflationary, because everything we get up from the U.S. would then cost more. It's also stimulative to it's stimulative to the Canadian economy. So if we don't raise rates, it could be the opposite of what the Bank of Canada wants. It's not that you're ever able to stand still. You're either going forward or backwards.
Sounds like a counteractive move if the United States decides to raise rates, Brendan. Now, in terms of how these rates are affecting Canadians, we know they have some sort of impact on everyone, but quite a significant impact on immigrants and millennials in particular. Can you tell us a little bit more about this?
Yeah, I mean, if you owe more money than you have saved, and that describes people that are new to Canada or people that don't outright own their own home yet, they owe more money than they're saving. So the price of money, the price of borrowing, works against them. If you're an oldie like me, or the generation older than I am, and you have more investments than you do debts, then higher rates actually help, because, well, you're getting more on your savings and more on your GICs. Now, the funny thing, though, is a 5% GIC is still actually losing you money in real dollars if inflation is in fact higher than that. So I think where the rate of inflation goes, both the published rate and the real rate in the world, I think will determine quite a bit going forward.
All right, Brendan. Well, on the note of inflation, I want to touch on food inflation, which continues to impact Canadians across the country. We have concerns around food insecurity, but at the same time, Loblaws recently posted gains in terms of profits, and the CEO of Loblaws recently received a raise. So how does all of this make sense in terms of dichotomy, Brendan?
Well, I have a very good friend who says you can be right, but you can be dead right. And I do think the optics of raising salaries, well, normally with the economy is doing well, nobody has a problem with it. But our food bank that my church runs, before the pandemic, we were looking after 70 families a week. We now look after north of 500 families a week come to get food at our food bank. It's gone up sevenfold and more since this started. So there is a food insecurity issue. Prices are going up. The wisdom of having these public salary increases for CEOs of companies that distribute food, I don't know it's the best time for it. You can be right, but you can be dead right.
All right, Brendan. Now, this might be a difficult question to answer, about 45 seconds left here, but is there anything that Canadians themselves can do to curb inflation?
Any legal thing? I was just reading, my good friend Joe O'Connor wrote a brilliant article in the National Post about the increase in shoplifting at grocery stores. So I don't think that's the thing. I do think that to the extent you have a mortgage, as we've talked about before, even if you've seen your floating rate mortgage go up in yield, I do think a fixed rate here is the safer bet. while interest rates might not go up terribly quickly, I don't think they're going down anytime soon. And I think a fixed rate is going to be better for people than a floating rate in the foreseeable future.
Always great advice. Again, thank you again for your time today, Brendan.
Thank you, Nima.